If you have tried to outsmart the markets and your portfolio still acts like a roller coaster, today I will show you a strategy that is boring, brutally simple, and historically hard to beat. That is passive investing. There is no crystal ball, no 12 monitors to juggle, just math, patience, and results. Let me fix your plan in the next few minutes. In this video, you will learn investing, passive investing that is, why it works, how it works, exactly what to buy, and a 3-step setup you can finish in 15 minutes. Plus, the biggest mistake beginners make and how to avoid them. Hello, I'm Telex. I've been trading since 2015. I've been coaching since the COVID years in 2019. I've traded actively for a decade at least, right? And coach people here since 2019. I love price action and options. Yes, that you're on the channel of the 10 baggers, and I will be the first one to tell beginners. Passive investing is the foundation. Build this base, then layer your skills on the top, right? So for us, this is a series that we started last week, and we are going to be continuing it here so that by the time we are done, you will be ready to start your passive investing. We will be bringing you tools. We have a blog where most of these articles are and topic are discussed in detail. So here in the short video, I'm just giving you a glimpse of the resources that are at your disposal so that you can be successful in your passive investing. I'm using this a Reels equivalent on here. So in my story here, as I could have begun, was okay. Trying to time the markets, you find yourself in a situation where, hey, your portfolio is down a great deal, is not matching, is nowhere near what's happening, for instance, with a leading market indicator, the S&P 500. Yeah, that's what's happened for me. And then I discovered, oh my goodness, I need to change something on here. So changing something consists of what? Passive investing, by simple definition, is you decide that you're going to buy a diversified index fund. So we will have in our next video differences between index fund and ETFs, exchange traded funds. They're quite similar, but we will break that down in the next video. But in this case, you're buying these and you're holding them forever. You're holding them forever. So then a question comes to mind. So are you telling me that you hold them during those downtrends, such as during the COVID? Yes, absolutely. Yeah, I remember where I was in 2020 on the other side of the Atlantic, and on this very channel, I was telling people that I'm not looking at my 401k because at the time it was just chaos. Why? 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 Because there's a paradigm shift, folks, when you are doing passive investing, which consists of, hey, I'm owning the whole market, so I have the peace of mind that the market will recover. That's one thing. And the side of me which is, I see this opportunity. Let me try to see to get onto this stock that people are talking about. No, no, no. It's just consistently investing your money into a basket of stock. In the case, a basket of stock, which is the entire market. What are the benefits? If you ask, I'm glad that you ask. Yeah. Well, my friend, you are not concerned about the so-called, I call it noise, really, the up and down of the daily of the markets, right? So you're not spending time researching, what's the latest stock, what are the charts telling you. These investment vehicle that we're talking about here, they have very low cost. There is something about actively trading which sometimes we ignore, but trust me, at the end of the day, if you have done it, the fees associated with all of the trade that you make, that can go a long way into eating onto those profit that you are making. On the other hand, buying an index fund or an ETF here, or a target date type of investment vehicle, definitely will put you at ease of mind. An example on here of a real performance. This is a person that I've had starting with simulating here $15,000. Do not change the allocation, but consistently putting the money in, and the portfolio can grow to a substantial amount. But the thing is that during all of the market's chaos, yeah, you have got to have the confidence that, hey, uh, it will pull through. And the advantage there's something that's that strategy that will put you at ease throughout the downtrend of the market, because you will be able to buy at the lower price as well. So this is something that we will be talking about in one of our next video in this series. It's called dollar cost averaging. Yeah, the concept that, hey, the market goes down, well, all of the assets will be cheaper. The previous month or 6 months before, you were buying them at, let's say, $40. COVID come in, you are buying the same one at $20. So your cost, it's lower. And the time that you have, for instance, if you are looking for 30 years, 20 years from now, trust me, that money definitely will go. So in here, we're giving you 4 steps here to start. Yeah, choosing a platform. We have numerous articles on the blog on how to choose a platform. In this case here, there are two here that's but they are not limited to that, right? So, and then you can pick a target date fund. They offer those based on when you think that you will retire. So those are standard. Could be 30 years from now based on your age. And again, we have information on how to actually calculate that. Uh, or a three fund portfolio. So meaning, yeah, 3 different ETFs, and we will show you certain that we like that are really basic. You automate monthly contribution. A lot of places help the investors do that nowadays. And then there is another feature. The two things to remember today out of here. Two new concept maybe. Dollar cost averaging. The other one, it's they use the word drip for it, which is dividend reinvestment plan. We will be breaking them down. Or if you are curious, before we make the video, on successfultrading.com, we have article detailing those. So yes, when you automate this, it means that the money that comes out of your dividend, you come, instead of taking it out and using it for, I don't know, what you may have as planned for that, you reinvest that money buying the same type of thing. We will break that down and to see the powerful effect on that by comparing, hey, here's an investor, they two investor, they actually invest in the same instrument, right? They call ETF or index fund, but one decided that, hey, I'm going to invest the dividend, the other one is taking the dividend away. Over a long period of time, it's mind-blowing how much money the person doing drip or dividend reinvestment plan actually gets. So an example on here of how the money can compound over the time. Yeah, $200 a month from 30 years for 30 years at 7%. 7% return for index funds or ETF, that's reasonable. We have had years here in the US. I think the example that we showed between 2015 and 2025, where we are now, double digits. It's about the average. It doesn't mean that is a guarantee for the future, but here, taking a number like this, yeah, $200 a month. Imagine for 30 years, that's come up to a whopping 246,000. But let's think about this for a moment. How much money actually are you putting in during that 30 years? Yeah, it's only $72,000 that you're contributing. The rest of the total value of the portfolio here, 70%, it's coming from the compound growth of this at 7%. So imagine that. So you put in 72K, and 30 years you get 246K. So you're putting in a third, and then it's bringing the other two-thirds. That's just mind blowing. So before we let you hear, there's some mistakes that even people who take the step to start doing passive investing can make. Yeah, yeah. The idea of panic selling. For me, I want us to stress on that one, because we the market cannot go up all the time, right? There will be period or phases where the markets will give the tendency that everything is falling apart, the sky is falling apart. Do not resist the temptation of selling everything, because during those phases is actually when most of the wealth is being transferred, because people who have cash at the time when assets are at the lowest price, right? Guess what? They are the one who come on top when the market recovers. So I avoid trying to avoid that. Also, the other thing, you're switching funds. So, meaning today, you see, let's say after 3 months, you look at your portfolio and you see that, hey, this other fund has a return over a short period of time, 6 months or 3 months, which is, let's say, double yours. The ideas. Oh, I need to switch to that one. I remember I was tempted into doing that several times, but typically that's not the best way to go. You need to stick to your picks for a long time to really come on top. Yeah, this is a curve that we showed you last time. All right, remember of this between passive and active investing. So we left that in here because it will help us out. But next week, really, we will spend time showing you the difference between index fund and ETF before we carry on into the other topics: DCA, dollar cost averaging, DRIP, dividend reinvestment plan, and all of these tools. We even have a calculator, I believe, or we just build a calculator for return on investment because some people get tripped onto that. So, hey, we are just getting started on this series on passive investment. We're looking forward to speaking to you in the next video. Until then, have a great evening, have a great night wherever you're watching from. Bye bye.